Doesn't necessarily mean bad to investors today. Shares are up by about $2 in European trading. Stock also rose after hours. Let's talk more now about Dell's quarter, its sales, and maybe a little bit about the counting probe. Richard Stice joining us now. He's an analyst at Standard & Poor's Equity Research. Richard, we appreciate your time. I mean, listen, Matt Nesto and Deirdre have been talking about the story. Dell highlighting the fact that it would like to sell perhaps fewer computers but make more money on what it sells. Is that the main theme that we can take away from the results, or is there something else?
No, I think that is the main theme. I mean, I was looking at the margin line in particular, and if you look at what they did from a gross margin perspective, they came in about 100 basis points ahead of my expectations. And I think they're making a prudent decision here, which is not going after market share in each and every instance, when in certain cases maybe the profitability levels won't filter down to the bottom line. And so I think more of a focus on profitability and a little less on market share is appropriate at this stage. And I think that that's what drove the earnings upside this quarter.
But that's an easy thing to say and a hard thing to do. I mean, every company would like to sell, things that they make for more money, but at the same time, you meet consumer resistance. I mean, can Dell do this? I mean, do you think they're going to be able to accomplish this plan?
Well, they're certainly off to a good start this quarter. Obviously, the prior couple of quarters where they had pre-announcements, they weren't executing on their strategy very well. I think they're doing a better job in terms of taking Hewlett-Packard more seriously. I mean, they even acknowledged that they were surprised at how quickly HP was able to gain share over the last 18 months. So I think that they're looking at them as obviously a very formidable competitor and doing a better job in terms of their forecasting and their overall planning.
Obviously, no conference call. We didn't do any interviews with Kevin Rollins. I mean, you read through the release. What are some of your takeaways, other than what we just talked about?
Yeah, well, I mentioned the margins. A couple of other takeaways in terms of their server unit growth. They gained some share there. Doing quite well over in the Asia-Pacific region, especially if you look at China and India. Although the U.S. is still weak, down 4% on a unit basis. In terms of the laptop or their mobility growth, that was up 17% on a unit basis, which is, I think, fairly reasonable, but it sort of pales in comparison when you look at and compare it to what HP and both Apple did during their most recent quarterly results.
The stock, as we showed it, up $2. People say, oh, it's good news, and, they bottomed out around 18, so if you bought it there, you're looking good. But listen, we don't want to get too giddy, right? Because Dell shares still down for the year, even with this $2 pop, and it was a $40 stock just over a year ago. I mean, at what point do we need to start maybe entering or exiting Dell if we had already owned it?
Right. Well, in terms of what our call, we have a hold recommendation on the shares, and following the release yesterday, we upped our 12-month target price to $28 a share from $25. You mentioned that performance-wise, if you look at the larger picture, they're still down from their all-time highs. And let's keep in mind that there's a formal SEC investigation going on. And so in spite of the fact that I think on an execution basis they certainly did better than they have the last few quarters, there's still that tremendous overhang over the stock here. And beyond that, you mentioned the transparency in terms of their communications have really kind of fallen off a cliff. There's no conference call this quarter. They canceled their analyst day that was supposed to be scheduled for September. So I still think there are a lot of question marks and a lot of things that they need to overcome.
But it didn't stop you from raising your target price. I mean, what's it going to take for you to raise your rating? Is it going to take more transparency or more solid results?
Well, I think a combination of the two. I think the transparency issue maybe is the most important, so you can just get more clarity in terms of what they're seeing in the marketplace, in terms of inventory levels, in terms of demand, new product rollouts, things of that nature. But also, it's an execution basis, too. I'd like to see at least another quarter or two of more solid execution, and then maybe get more constructive on the name at that point.
Is Kevin Rollins' job at risk?
That has been coming up over the last couple of quarters. I think putting up a quarter like this maybe will put that aside for now, but if their execution deteriorates once again, or if there are some serious malfeasance that is found relative to the SEC investigation, then I think that there's a good possibility that Michael Dell can come down and take, once again, a more active role in the company.
All right, so the takeaway here necessarily, based on your new target price of 28, is you might want to start to think about trimming some once we get to that level, correct? Because especially if you bought at 18, you made a little bit of money. The people who bought it higher than that, I would imagine, just kind of hold on to it? Or?
Yeah, I mean, certainly if investors already hold the shares, we're advising them to hang on to them at this point. But we're not. What we are saying is we don't want people coming in and taking new positions at this stage.
All right, Richard Stice, analyst at Standard & Poor's Equity Research. Richard, a pleasure. Thank you very much. Have a great Thanksgiving, and we'll see you again soon here on Bloomberg.
Thanks, you too.
All right, take care.